Hi, it's the Tax Geek here with more of your taxes oversimplified. In this episode, we're going to look at 3 different ways a business can be structured and how those structures are treated by the IRS. When it comes to organizing a business, you essentially have these choices. You can operate as a sole proprietorship if there is only one business owner. You can operate as a partnership if there are multiple owners of the business, or you can form a traditional corporation or a limited liability company, otherwise known as an LLC. For corporations and LLCs, you can elect for tax purposes to be either an S corporation or a C corporation. LLCs can also be taxed as sole proprietorships or as partnerships. In fact, unless you elect otherwise, this is the default way the IRS will treat your LLC. Single-member LLCs are treated as sole proprietorships and multi-member LLCs as partnerships. I'll go into LLCs in depth in another video, but the oversimplified definition is that an LLC is an entity formed by one or more members to shield themselves from any liability the LLC may incur. So that said, let's look at sole proprietorships first. A sole proprietorship is formed when a single individual goes into business for themselves with no formal structure aside from, perhaps, obtaining a business license. Proprietors report their income and expenses directly on their tax returns using a Schedule C. The net income is then carried to Schedule 1 and in turn to Page 1 of Form 1040. The net income from the business is also used to calculate self-employment tax and qualified business income deduction. Self-employment tax and qualified business income deduction are discussed in more detail in other videos, which are linked below. A single-member LLC is by default a sole proprietor, unless he or she chooses to be treated for tax purposes as a corporation. When multiple people go into business together without some sort of corporate structure, they have formed a partnership. Partnerships often have formal partnership agreements, although it is not required by law to have one. A partnership files its own tax return on Form 1065. This looks much like the Schedule C a proprietor files, but is filed separately from the partner's individual returns. Rather, each partner will receive a K-1 form reporting their individual shares of the partnership income and other income the partnership may have, such as interest or capital gains, which is then reported on Page 2 of Schedule E and then eventually to the appropriate lines on the partner's 1040. Just as for a proprietor, the share of partnership income is usually subject to self-employment tax and qualifies the partner for a qualified business income deduction. And just like a proprietor, a multi-member LLC is by default a partnership, unless it elects to be treated like an S or C corporation. A partnership is taxed very similarly to an S corporation. Like the partnership, an S corporation also files its own tax return, this time on a Form 1120-S, and each member's share of the profit is reported on a K-1 as well. Active participants in S corporations are usually paid regular salaries by the corporation, which the members report as regular wages on Line 1 of Form 1040. If this is the case, any residual profit reported to the member on Form K-1 is not subject to self-employment tax, but is eligible for the qualified business income deduction. Partnership and S corporation losses are also passed through to the members and may, under certain circumstances, be used to offset other income. To be able to do this, you must actively participate in the partnership or S corporation and have an amount that is at risk. In other words, you must have some sort of personal investment in the business or personal liability for the debts of the business. Also note that if you are a member of a partnership or S corporation, you are taxed on your share of the net income whether or not you received it in cash. Any undistributed net income increases your investment in the business and provides you with a taxable economic benefit. Finally, we come to the traditional corporation, or as it is commonly called today, a C corporation. Like partnerships and S corporations, C corporations file their own tax returns using Form 1120. However, unlike these other entities, C corporations pay taxes directly on their net incomes. Any profits that C corporations distribute to their shareholders are considered dividends and are reported on line 3 of Form 1040 and taxed accordingly. Thus, with C corporations, we have a type of double taxation, where the corporation pays income tax on its profits and taxpayers pay tax on this profit when it is distributed to them as dividends. But since corporate income tax rates are sometimes lower than individual rates, and most dividends are subject to capital gains rates, the overall effect of this double taxation is reduced somewhat. Any net income that is distributed to taxpayers as dividends is not subject to self-employment tax, nor eligible for a qualified business income deduction. If you have an LLC and would like to have it treated as an S corporation, you need to file Form 2553 to make the election. To have an LLC treated as a C corporation, you would file Form 8832. In this video, we've just scratched the surface on business taxation. More in-depth information will be presented in other videos, and additional resources and information is given in the links below. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. And as always, thanks for watching, and I'll be back soon with more of your taxes oversimplified.